Attendees are in listen-only mode.
Well, good morning, everyone. My name's Michael Carmody, one of the senior managers here in the Worrells Victoria office. Joining me today, we've got Aaron Lucan, a principal from the New South Wales office, together with Jason Beddles from our Queensland offices. We would firstly like to extend a warm welcome to you for our second episode of the Worrells webinar series, presented by our very own Aaron Lucan, where he will present on the topic, the insolvency landscape for 2023, which we will look to provide a wide view on how we see the Australian insolvency landscape for the year ahead. Specifically, this webinar will address the ATO's approach to debt collection, how creditors will approach debt collection, in particular landlords, for deferred rent, your client's options for how to deal with debts, how credit accessibility is going to likely change, key challenges affecting the businesses, and key case studies to tie it all together. Like our previous webinars, this webinar will be recorded and will be available for viewing after via our website, so feel free to share it amongst your colleagues. Some final housewarmings before I pass over to Aaron. Firstly, if anyone encounters a technical difficulty, as mentioned earlier, we are recording the webinar, which will be available on our website. Secondly, if you do have any questions throughout the presentation this morning, please submit them using the chat function. Before the presentation concludes, we will have an opportunity at the end to try and answer as many of those questions as possible. Finally, in the coming days, you will be emailed those CPD certificates to assist with meeting your continual professional development requirements. Now, without any further ado, I'd just like to once again introduce Aaron to start the presentation. Over to you, Aaron.
Thank you very much for that, Michael. And just before I get started, we've got the acknowledgement of country. So in the spirit of reconciliation, Worrells acknowledges the traditional custodians throughout Australia and their connections to the land, sea and community, specifically where I am here in Parramatta, the Darug people. We pay our respects to the elders past and present and extend our respect to all Aboriginal and Torres Strait Islander peoples today. Now, up on the screen now is a standard disclaimer. Now, any second now, there's going to be a little pop-up on your screen there. I just want you to tick that off once you've read that. Thank you very much. Well, you're also very quick. So, I don't know how many of you have ever done a webinar presentation, but it's a pretty hollow affair as a presenter. So I'm going to pretend here that you're all laughing at my jokes, and that's going to keep me in a good mood and spirits high, and hopefully we can make it entertaining for you today. So this presentation, as Michael gave us a summary in the overview, is covering 5 key areas in the insolvency landscape. How this came about, I co-wrote this paper with Brendan Giles from my office, and we had done we ran a survey at the end of last year. Some of you may have participated in that, and we asked people what it is they wanted to hear from us. We got a number of responses, and we basically threw them into the melting pot and came up with this presentation. So what we're going to look at is how the ATO is going. We think they will approach debt collection in 2023. We're going to have a look at the approach that some of the other creditors are beginning to take out there in the marketplace, and how things are evolving in the kind of post-COVID lockdown business interruption type period. We're going to have a look at some of the options that we're seeing clients use to great effect. We will have a look here at small business restructuring, which is one of the key things that people wanted to hear from us. We're going to provide some insight into how creditors and the marketplace is changing, and how that will have access to credit for small businesses over the coming year. And then we're also going to have a look at some of the key challenges that we see businesses dealing with, and how to survive those challenges throughout 2023. And then finally, we're going to have a look at the changes that might be coming to the insolvency legislation as a result of some of the government roundtables, etc., that have been going on at the moment. So without any further ado, we'll kick things off by having a look at what the situation is like for the biggest creditor in Australia, and that's the ATO. And at this point, everyone is well aware of the approach that the ATO has taken to debt collection throughout the pandemic period. They took a compassionate and supportive approach to enforcing tax debts and giving businesses, and especially small businesses, the breathing room that they needed throughout the pandemic period. The government put a lot of money into supporting businesses throughout the pandemic period. There is a large amount of tax debt out there, and they're not too eager to wind up those businesses that they kept afloat during that period. And so nothing highlights and just how relaxed the ATO's approach has been to debt collection over the pandemic than the graph which is on the screen right now. So what this shows is that in an average year pre-pandemic, the ATO would wind up a little over 2,000 companies. But over the last 2 financial years, they've wound up just 5 and 10 respectively. And then in the year this so far to December 2022, despite all the talk of the ATO recommencing its debt collection activities, they've still only wound up 65 companies in that period. Now, in an ordinary pre-pandemic world, the ATO would have wound up over 1,000, perhaps up to 1,800 odd companies during that same period last year. So as we discussed, the ATO's debt collection activities through the last year and looking forward into 2023, it's important to keep in perspective just how little the ATO has been doing in this wind-up space. That being said, the ATO has a huge debt problem which has accrued over the last 3 years, and they've expressed a commitment to addressing that. In fact, in the ATO's more recent annual report, which was in October 2022, the ATO stated the following. This is a quote from that paper. As the economy recovers, one of our key priorities is to address the collectible debt that has accrued over the past 3 years. This has increased from 26.5 billion at 30 June 2019 to 44.8 billion at 30 June 2022. So it's clear that the ATO's debt problem is large. $44.8 billion is a huge amount of money. And to give a little perspective on just how big that is, that would buy 492 of those fancy new F-35 Lightning jets that the government is acquiring at the moment. It would be enough to build another 430 Sydney Opera houses, or about 631,000 mid-spec Hilux utes. Although I expect with a fleet that big, you'd be looking for a fairly significant discount and trying to get your hands on a few more. Almost all of this debt relates to companies. Less than 10% of it relates to individuals. And the biggest contribution by far to that is from small corporate businesses, who account for 29.3 billion or 65%. So as a result, much of the ATO's debt collection focus at the moment is on small businesses, and they're taking a top-down risk-based approach to debt collection. So this means that they're focusing on larger debts and debts the ATO considers higher risk, which generally means companies with a worse compliance history. The ATO is employing 4 key tools to try and manage this debt and encourage businesses to take steps to repay it. And we're going to run through each of those in turn as we go on, but briefly in summary, those are payment plans, director penalty notices, credit reporting, and wind-up notices. So we'll start by looking at the first one of those now, which is unquestionably the softest of the ATO's debt collection activities, and that's repayment plans. To put it simply, a payment plan is just a formal arrangement that allows the taxpayer to pay their tax liability over time. There are a few key points to keep in mind while the taxpayer is subject to a repayment plan. And that's that any credits or refunds received are going to be withheld by the ATO to reduce that tax liability. And that the ATO is going to continue to charge interest on that debt at a very high rate. At the time we wrote this paper back in February, that was 10.06%. Will have gone up a little bit since then as well. which is significantly more than you might expect to be paying on a corporate finance loan at the moment through a bank, for example. So it is an expensive form of finance. And then the final thing is that the company still has to lodge and pay all of the activity statements and return on time while making those repayments. So what that means is that the payment plans can lead to very significant cash flow problems for businesses. And we've actually got a case study coming up a bit later on looking at exactly that sort of scenario. In recent years, the ATO has been very willing to enter into repayment plans, even in circumstances where the company might have already defaulted on previous payment plans. Those of you accustomed to dealing with the ATO would know that that was very different to what their approach was pre-pandemic, when they were looking for, might have been 50% upfront and then fairly short-term repayment terms. That softened a lot during the pandemic period, and what we've been hearing from accountants and what we've been observing ourselves is that the ATO is really starting to tighten up their requirements around payment plans, and that accords with what they were telling us in around July last year was their intentions as last calendar year closed out. In particular, we've seen numerous cases where companies that have defaulted on payment plans being refused another one, and we've got a few accountants here today who would have been really seen that change in the ATO's attitude. There's also a significant catch with payment plans, which is that all of the debt remains due and payable while the payment plan is in place. So it used to be that we might advise clients that if you enter into a repayment plan, that debt is not due and payable in full. It's only the monthly or quarterly contributions, whatever they might have been, that were due and payable. So from the point of view of considering insolvent trading, that was perhaps a good strategy. However, that's the court has clarified that in the matter of Clifton Liquidator and Kerry J Investments Proprietary Limited. That as a result of entering into a repayment arrangement with the ATO, that does not remedy the solvency issues for a company. So accordingly, a payment plan with the ATO can still leave directors exposed to insolvent trading and breach of directors' duties claims should the company later fail and a liquidator be appointed. Director penalty notices. Now, these are certainly the ATO's weapon of choice at the moment. It's the main tool that the ATO have been using to encourage companies to pay their tax debts and director penalty notices. Now, a DPM, we've spoken a lot in our various seminars on these webinar series and in our face-to-face seminars around the country about what a repayment arrangement is, what a director penalty notice is. So we won't go into too much detail there, but it is it's a notice that can potentially make directors personally liable for a penalty that is equal to the overdue taxation debts of a company. Those include primarily PAYG, GST, and superannuation guarantee charge amounts. Now, this is obviously not something we want. One of the key reasons that directors make use of a corporate structure is to take advantage of corporate veil. There are two types of director penalty notices, and the options available to directors differ depending on the type of DPN that's received. The two types are, we call them a non-lockdown DPN, which is the least bad of the two, and the lockdown DPN. Now, a non-lockdown DPN can be issued by the ATO when a company has lodged its business activity statements on time or substantially on time, but the debt remains unpaid. Now, in that circumstance, a director can avoid personal liability for the penalty by doing one of four things, that is paying the debt, of course, putting the company into liquidation, into voluntary administration, or commencing a small business restructuring process. The most bad of the two is the lockdown TPN, which can be issued when not just when the company hasn't paid the tax debt, but where it failed to lodge its returns in a timely manner. The returns don't have to be lodged by the due date, but they do have to be lodged within 3 months of the due date. So any statements lodged outside of that 3 months can be subject to a lockdown DPN. So while no DPN is good, you should think of the non-lockdown DPN as the better and the lockdown one as the worse of the two. The only option available to a director who receives a lockdown DPN is to pay the penalty or seek relief under one of the statutory defences, which is often very difficult. However, there is often some harm minimisation strategies that we might be able to help clients with. For instance, there's usually some non-lockdown DPNs that accompany the lockdown DPNs, and that's the portion of the personal liability which can be avoided. So the ATO is going to give directors 21 days to take one of the following actions, and that is to pay the amount which is outstanding, to put the company into administration, to appoint a small business restructuring practitioner, or for the company to go into liquidation. If the company takes one of those steps within the 21-day period, then the ATO must remit that director penalty, meaning that there is no personal liability that sticks with that director. Moving on to credit reporting. So if a company meets a set of criteria, the ATO may report the unpaid tax debt to the credit reporting bureaus. This makes it more difficult for a business to obtain finance, and it can make rolling over existing finance more difficult and more expensive. The ATO has made very limited use of this power so far, with only around 700 businesses being reported for unpaid tax debts in 2022. For the ATO to disclose a tax debt or report a tax debt, the debt must be over $100,000, must be overdue by more than 90 days, and the company must not be engaging with the ATO to resolve their tax debt. Now, that engaging point is not just picking up the phone and the ATO answers or calling them to say, sorry, I'm not going to be paying on time. The company has to be complying with a payment plan or have an active objection to the debt in place with the ATO. Interestingly, these notices tend to be counterproductive in some circumstances, as they make it very difficult for a business to access credit and make it more likely that the business will ultimately fail and not pay its tax debt. The strongest of the ATO's debt collection tools is unquestionably to take steps to wind up a company through the courts. This process results in a liquidator being appointed to sell the company's assets, investigate what led to its failure, and distribute any surplus assets to creditors. Now, we started off this section of the presentation by looking at just how slowly the ATO is moving back towards winding up companies. However, we don't think that this state of affairs is likely to last. As softer approaches to tax collection fail, the ATO will be increasingly forced to rely upon winding up in order to bring down the debt in their books. And we saw a similar trend after the GFC, where initially the ATO took a very supportive stance, and then they switched to more aggressive enforcement approaches over time as the softer approaches weren't working. And we expect to see a similar trend here, with the ATO slowly ramping up their stricter enforcement to bring down the total debt, with a similar trend towards less accommodating deals available through small business restructurings and voluntary administration as time progresses. The key motive of the ATO through the last 18 months has been to support businesses and to make sure that the investment in businesses that was made through measures like the cash flow boost and JobKeeper isn't squandered. However, the further we get from those measures in time, the longer businesses wait to deal with their tax debts, the less sympathetic we think the ATO is likely to be. So an important question, is how is the ATO going so far in the debt collection activities and using these softer tools that they've been implementing. So early this year in January, the ATO reported on their activities to date. So they had issued over 100,000 warning letters to directors requesting that they engage with the ATO or that they risk receiving a direct penalty notice. Over that same period, they issued almost 18,500 direct penalty notices, and there was nearly 500 businesses that were disclosed to reporting agencies. Now, that debt collection activity related to $17.3 billion worth of outstanding debt and resulted in only $714 million being paid, or around 4%. And then a further 5.4 billion, or 31%, entered into a repayment plan. So this means the vast majority of those contacted by the ATO just didn't respond to the warnings or DPNs. It probably also means that there are a very large number of expired DPNs out there. If this trend continues, we expect to see a significant increase in the ATO's wind-up activity, as there will be left but little choice but to liquidate companies to resolve the outstanding debt. The one key takeaway from this is get in now, the sooner the better. Now is the time for business to deal with their ATO debt, while the ATO still has a focus on supporting small businesses before that focus switches to a more collection-based approach. So while the ATO is the biggest creditor in Australia, they're certainly not the only one. And several other classes of creditors are starting to change their approach to debt collection as we get further away from the pandemic period as well, and back to what we would consider a more normal economy. So while the ATO's accommodating approach to supporting businesses is widely acknowledged, it's not so widely acknowledged that landlords generally provided a lot of stimulus and support to small businesses through the pandemic period. They were required to provide a number of support measures to small businesses, including rent reductions of up to 50% and extended rent deferrals. A set of regulations was enacted that made it very difficult for landlords to remove delinquent tenants, and those regulations place some ongoing restrictions on the recovery actions that landlords can take. In particular, landlords unable to evict a tenant for unpaid rent for the period from 13 July 2021 to 20 June 2022, unless they first attempt to renegotiate the rent or attempt a mediation process. Despite these hurdles, we're starting to see landlords take steps to collect rental arrears that accrued during the COVID period. And these approaches are generally falling into two main categories. First, we're seeing landlords looking to renegotiate rent payments to recoup some of the deferred rent over time. While this is a very reasonable approach, what we're seeing is that it puts significant pressure on tenants, especially in the retail and hospitality spaces, where they're also experiencing increased wages and increases in the cost of supplies. So, and then secondly, we're seeing some landlords take a more aggressive approach, pushing for full repayment or taking steps to evict tenants that aren't actively repaying their COVID era debts. And we're seeing this starting to result in increased business failures as well. There are two main ways that we're seeing businesses deal with this pressure. The first is that they're negotiating with landlords, and in some sectors, finding replacement tenants can be quite difficult, and then so this gives those businesses some leverage to try and negotiate a settlement. Secondly, we're seeing some businesses use formal approaches to create leverage. In particular, we've seen success with using the voluntary administration process to end a lease early and to deal with both the legacy deferred debt and the balance of the rent that might be payable on that particular lease, and that deals with it all under the moratorium of a voluntary administration and allows the debts to be settled through that process. And so that gives businesses flexibility to renegotiate a fresh lease either in the same location or with a new landlord. Next, we can have a look at some of the utilities and the larger corporate suppliers around the country. So as many of you will remember, over the initial COVID period, a lot of the major suppliers and the utilities providers adopted the same spirit that the government was encouraging them to take, and taking a proactive approach to supporting their small business clients. Especially we saw this in the hospitality and retail industries, where a number of major suppliers were offering discounts on invoices and deferral of payments to support small businesses, while also deferring any collection action on those unpaid amounts. This supportive approach continued through most of 2022. However, in the latter part of 2022 and so far this year, we've started to see that many of those major suppliers are returning to their pre-COVID business as usual collection processes. So they're issuing demands, they're issuing debts, and commencing wind-up actions. I'd give consent for one of the large suppliers to the construction industry, and come 1st of January this year, I started receiving requests for consents again, and I'm giving over several a month at the moment. That being said, we're still finding suppliers and utility providers generally responding positively to deeds of company arrangements and proposals for small business restructuring plans. And they're taking a very commercial approach to collecting what they can when they can. We'll have also debt collectors and mercantile agents. So they had been adverse to commencing formal insolvency proceedings over recent years. Some of the key reasons for that is the temporary measures that were introduced in 2020 in response to the COVID-19 pandemic. That included moratoriums against collection of some debts, increased statutory minimum debt thresholds for court applications for insolvency, and extended notice periods for wind-up and bankruptcy applications. And those are some of the key tools that they use to put pressure on debtors to pay. Also, even before the pandemic, following the Banking Royal Commission in 2018, we observed a decrease in bankruptcy and wind-up proceedings in relation to bank debt that was being managed by those mercantile and agencies and debt collectors. What they advised us at the time was that this was because some of the major banks were imposing contractual restraints on debt books that prevented the bankruptcy and wind-up applications being commenced. In 2023, we expect to see that trend will reverse and that debt collectors will become more active. That's for the following reasons. Firstly, those temporary COVID-19 measures have now eased. And we're also being told by the collection agents that they are preparing to issue bankruptcy and wind-up notices again. And this is because many of those debt books that they acquired post-2018 are now being on-sold as secondary books, and those contractual restraints aren't what they were back then. So with creditors starting to take more action to collect debts, those liabilities that have been sitting on the balance sheet for the last couple of years, having been deferred during the COVID period, are now starting to become a more risky proposition and starting to create cash flow difficulties. So let's take a look at what business owners can do now to deal with some of those accrued debts. So if you attend these sorts of presentations regularly, you'll be well aware of the options that are available. So rather than going through each one in detail and explaining them in detail, we're going to give a quick overview today. For companies, there are three main options that are available. First, we're going to have a look at small business restructuring, which is a relatively new process that allows small businesses to restructure their debts while also staying in control of their business. We then have the voluntary administration process, which is more complicated and more expensive than small business restructuring, but also allows larger and more complex businesses to restructure their debts. And finally, we have liquidations, which can be initiated either by the directors and shareholders of a company or by a creditor through the courts. And that results in the company being wound up with its assets sold off and a distribution hopefully being paid to creditors. So first we're going to have a look at a recent small business restructuring that I did, which really demonstrates the power of small business restructuring plans to save a business, particularly one that is doing the right thing, particularly in terms of its lodgements with the ATO, but really struggling to keep up with its ATO repayment plan. This particular business was an NDIS services provider, and it had around 60 employees, and it got itself into some trouble with the ATO over COVID to the tune of about $450,000. It had accrued that debt predominantly because it had kept all of its staff employed during the pandemic period. It had collected the JobKeeper payments. That was enough to pay the staff. The staff could not be on site providing services to clients, so they were generating no revenue, but it wasn't enough to pay the PAYG. They had managed to stay on top of their superannuation. They've done the right thing, and they were engaging with the ATO to try and resolve the debt, and that had resulted in an almost 3-year repayment plan of $17,000 per month. However, that was not a sustainable payment plan for this particular business because it only generated profits somewhere between $10,000 and $15,000 of free cash flow per month. So as a result, the director came to us to discuss winding up the company, but we had a better idea for him, which was to try and replace that payment plan with a small business restructuring plan. And this is why we call this slide the better payment plan. So we worked out a plan that was ultimately accepted by the ATO, whereby the company would pay $10,000 per month for a period of 12 months. That was an amount that the company could afford, and that resulted in a return to the ATO of around 24 cents in the dollar. Our fees on top were $15,000, which means that there was a total cost to the company of $135,000. There were some other smaller creditors that were fairly insignificant in the grand scheme of things. Most other creditors have been maintained, and it was only the current liabilities that were still outstanding. To make it clear just how much better the small business restructuring plan was for this particular business compared to the ATO repayment plan, we've put them side by side on this slide. So had the company sought to continue with the repayment plan, it probably would have defaulted and not survived. The total cost under the repayment plan was $595,000. We've estimated that because we've made an estimate on the interest. The monthly repayments were $17,000 as opposed to the $10,000 per month under the restructuring plan. The period of the plan was 12 months as opposed to the 35 months remaining on the repayment plan, and the interest paid was $0 compared to the estimated $145,000. So it's $135,000 versus $595 that would have been paid had it continued with the ATO repayment plan. So clearly a better outcome for that particular client. For larger entities, the small business restructuring process is not an option. However, they still have access to the voluntary administration process. Now, this particular case involved a formwork and concreting contractor that was suffering from financial distress as a result of a combination of 3 factors, really. The first was that they were unable to work on a number of projects during the COVID lockdown period, which had negatively impacted cash flow and saw them falling behind on tax and super repayments. So cash flow had then been further impacted by a string of wet weather delaying of projects, and a decrease in the accompanying revenue that would have come with a timely completion of those contracts. They had entered into some leases for new equipment, and much of this equipment was no longer required given the post-COVID level of work that was available to them. And this included some inadvisable, or what we would call lifestyle leases that the company had entered into for luxury motor vehicles, and they just weren't generating the sort of revenue that was required to keep up those vehicles. It was putting too much strain on cash flow. And then finally, the company had a major debt affair, which resulted in the writing off of approximately 350 grand in bad debts. So these three factors together meant we had a business that owed about $1 million to the ATO, of which about 60K was super and about 300K was owed to the suppliers, and about 250,000 in lease shortfalls on the luxury cars and equipment that they no longer needed and could no longer afford. So to resolve these issues, we put the company into voluntary administration, and that allowed us to hand back the leased equipment that was no longer needed and to crystallise those debts so that they could then participate as a creditor in the deed of company arrangement, which was to be proposed. Sorry, got ahead of myself. Crucially, to pass the deed of company arrangement, we only needed a majority of creditors in number and value. We knew that both the suppliers and the ATO were supportive of the proposal, so we didn't have to worry too much about how the finance companies were going to feel about this process, as a vote would not be able to block the deed proposal. And in the end, the ATO and suppliers voted in favour of the DOCA. It paid 26 cents in the dollar. It resolved the company's legacy debt problems and taking a large step towards resolving their cash flow issues going forward as well by cleaning up what was there on the balance sheet coming out of COVID. Now for a slightly different story, we're calling it sweet relief. And this is one where we didn't save the business because the client didn't really want us to. And that wasn't going to be the best outcome. And actually, we've had a number of very similar ones to this over recent months. So this case involved a roofing contract business that had been having issues for a long time before COVID. And then COVID just made everything even harder. The company had a significant legacy ATO debt problem to the tune of almost $2 million. And COVID had just made matters worse. And by the time they came to us seeking help, the company owed the ATO almost $3.5 million. The director of the company had had enough. He'd been living with the stress of running a business and the ATO tax debt hanging over his head for years. And he just reached the point where all he wanted to do was shut the business down, walk away and go back to working for wages. And in fact, he'd already found himself employment in another job and was just looking forward to closing this chapter of his life. So despite issues with payment, the company had a pretty good compliance history in terms of its lodgement of BASs, etc. And so there was minimal risk in relation to lockdown DPNs at some time in the future. There's a few little blemishes there on the lodgement history that we did a quick review on, made him aware of. But he placed the company into liquidation. I was appointed liquidator just to wind it up. The company had minimal assets to deal with, and the ATO was the only creditor remaining. As the director had paid out the suppliers and subcontractors as he prior to moving to wind up the business, they were fairly minimal amounts, so there wasn't any great concern there around preferential payments. It was all a little uncommercial to pursue all of that. So this is a really good example of where saving a business is not always the best option for everyone. Running a small business is hard work and it takes a lot of time and is often very stressful. And often we meet business owners that just want the stress and worry to end. Oftentimes it's their ego that is forcing them to continue because they don't want to fail. But for them, often a liquidation is going to be the best option. Let's check how I'm going for time here. Still 20 minutes. So with the options and those few illustrated case studies in mind, we're going to take a look at the other key challenges that we expect to see businesses facing in 2023. So heading into 2023, we have a really abnormal state of affairs in the Australian economy. We still have high inflation, which has led to rapidly rising interest rates. We saw, I think, was it 10 or 11? I can't recall, consecutive interest rate increases. And as a result, we've seen consumer confidence fall to levels that we've only seen before during lockdowns. But at the same time, consumer spending has remained primarily well above trend, and it's until recently showed little sign of slowing. We have unemployment at record lows, with more than one job opening available for each unemployed person, but we've seen minimal wages growth in response to that tight labour market. And also business confidence remains very high despite a large jump in the costs of supplies and energy. So in short, the economy really hasn't been responding the way we would ordinarily expect it to, given the economic conditions we're currently seeing. So it's likely that this is an anomaly. There's a unique set of circumstances that led to our current economy, including lockdowns, closed borders. Our largest trading partner closed their economy for a very long period of time, and never before seen government stimulus. And these are all combined to mean that the ordinary rules just don't apply. However, it's only a matter of time before those unique circumstances work their way through the system and the economy starts responding to stimulus as usual. And this process will create some key challenges for businesses in 2023, at least so far as we're predicting. So we expect that small businesses are likely to face two key challenges around staffing in 2023. Trouble finding enough staff, especially in the trades and the professions, and rising pressure on wages. This shortage of workers is profound. We currently have more job openings than people to fill them. Since Australia closed its borders in response to COVID and net immigration switched to negative, we have had a labour supply crisis in Australia. We've long been reliant on overseas students and migrant workers to maintain our workforce. And while we have reopened our borders, the return of flow of people into Australia has been quite slow. To put it in numbers, during the pandemic period, Australia missed out on approximately 180,000 permanent arrivals and around 400,000 visitors or recurring workers from students and short-term visas. So this equates to about 4% of the Australian labour force that just hasn't been around. So while we're seeing student workers starting to flock back to Australia, which should ease some of the employment pressures for unskilled labour, what we aren't yet seeing is the same trend with skilled migration, which is recovering very slowly. I think every professional who's listening into this today can attest to just how hard it is to hire skilled and experienced professional staff at the moment. So far as the shortage of workers, it's had a minimal impact so far on wages. However, the longer this state of affairs persists, the more likelihood there is that wages are going to start to accelerate. And in fact, this may already been occurring with the NAB business survey in January 2023 reporting that businesses were expecting average wage increases of 5% in the next financial year. So what can SME businesses do to deal with these issues? Well, I'm going to use Worrells as an example here. We are fundamentally an accounting practice, and we've faced the same issues as other accounting firms finding qualified and experienced staff. In fact, in insolvency, a lot of staff were laid off during 2020, and many of those haven't returned to the profession. And also, there was a period there of 2 years where not many people were employing graduates. So looking for staff with 1 to 3 years experience at the moment is very difficult because they really don't exist. To deal with this challenge, we took a two-phase approach. We focused on our staff retention firstly. So if it's really hard to hire new people, then you really need to look after the people that you have. So as a business on the smaller side of medium, we aren't in a position to compete with some of the larger businesses on salaries. So instead, we've focused heavily on making Worrells a great place to work with a strong culture. And to do this, we dialed in on what our staff want. We conducted some surveys and we engaged directly with them in conversation as people. We have invested heavily in automation. So technology has always been one of the central pillars of what we do at Worrells. We've responded to our staffing challenges by working on our systems to make the more menial and routine tasks done automatically. This frees up staff to do more interesting and work that they value more, which is an opportunity they can't get outside of us. This approach is working for us with our staff retention rates are fantastic levels, and our automation is making our staff more productive and happier. As I discussed in the introduction, despite very low consumer sentiment and rapidly rising interest rates and increasing costs of living, consumer spending has remained very strong. This graph is a little out of date now. We did produce this back in February, and consumer spending did drop off a little, resulting in a freeze on the increasing of interest rates, and then it rebounded again. However, this state of affairs can't last. History shows us that sooner or later, a combination of pressures is going to see consumer spending slow down, and we'll see a corresponding drop in business turnover and trading conditions. In fact, it's almost guaranteed that this will happen. The RBA has repeatedly stated its intention to keep increasing rates until inflation starts to slow, and a fall in consumer spending will be required to bring inflation down. Credit standards are tightening. So during the COVID period, the RBA provided a line of cheap funding to the major banks and lenders in Australia, known as the Term Funding Facility. Ultimately, this line of cheap credit provided $188 billion in money to be lent out. We saw a slight loosening of lending standards in response to that cheap finance facility. In particular, we saw asset finance being provided at very high loan to value ratios, sometimes exceeding 100%, particularly on some second-hand equipment where the price was rising very quickly due to new equipment being unavailable. The term funding program is now coming to an end, with banks having to repay their cheap loans to the RBA and roll over those loans to more expensive traditional finance. Alongside that move, we're seeing banks take steps to tidy up the risk profile of their loan books, and this is making it both more difficult to refinance existing facilities and more difficult to obtain new finance. Well, it's not last month anymore. It's 3 months ago now. We worked with a client who ran an $8 million rolling corporate bond facility through one of the big four banks. They had this facility and rolled it over on an annual basis with the same bank for the last 6 years. However, this year the bank advised that risk profile and the business was no longer someone that they wanted to fund. Luckily for this business, a smaller bank lender was willing to take on the facility, albeit at a higher interest rate, so that's going to create some cash flow stresses. But this story is indicative of what we're seeing generally. Apologies, I've just done a crazy scroll. The big four banks especially are seeing tough financial times ahead and preparing their loan books in advance. We're seeing a similar trend with businesses seeking new finance with lead times lengthening and the banks requiring more information before making loans. The lesson here is to make sure that clients are reviewing their finance facilities regularly and have contingencies in place so that if their current lender refuses to finance them, they have a backup in place or a backup plan ready to go. And secondly, clients shouldn't wait until the renewal is due. Engage earlier with the banks or funders. This gives an early indication of what the bank is thinking and gives them more time to source alternatives if that is required. The last challenge we'd like to look at is input prices for businesses in particularly energy and supply chain issues. So energy prices impact almost every business. Even an office like ours is full of computers that need electricity to run. And Australia is forecasting potential increases in energy prices of between 35 and 50% later this year. So, and that's despite the price caps introduced by government late last year. Similarly, while supply chain challenges have eased, we're still seeing pockets where the supply shortages and cost increases are hitting businesses, and this is especially a challenge in the construction sector. So anytime we see rising costs for businesses, the response really should be the same, and that is to carefully monitor and review costs and make savings where that might be available. This can include tendering for better prices and testing out different suppliers. Maintaining a detailed budget and make sure it is regularly updated to reflect changing in cost pressures, and regularly review pricing. So this is a big one that we often see businesses get wrong. They're very reluctant to increase prices because they're concerned that they won't get the next job, but there's little point getting the next job if there's no profit in it. So the simple solution to falling margins is just to increase your price. In an environment of rising inflation and with consumer inflation expectations running at above 5%, the negative impact of increasing prices is somewhat muted at this point. So if I've done my job well so far, then this slide should tie everything together. That we look at all of these factors, what it means for business is that we could be heading towards a big cash flow crunch. So businesses have increased cash needs. We've got the ATO collecting the accumulated debt on the balance sheet, as well as landlords who are looking to collect those deferred rents. And in both those cases, there is still the requirement to pay the current rent, pay the current period as. So that increases the cash needs, cash flow needs. Utilities are collecting their COVID period debts as well, and utility prices are on the rise. Debt collectors are becoming more active. We're looking at increases in wages and increases in inflation, requiring more cash, but we're also seeing potentially less cash being available due to consumer spending. So while overall spending remains high, in some areas it's already beginning to come down, and we expect that at some stage consumer spending has to respond to the increases in interest rates. And supply chain issues, which are decreasing or slowing down cash flows for some businesses. And anecdotally, businesses are reporting to us that it's harder and harder to get paid at the moment, that cash flow is really starting to slow down for them. And we're seeing this particularly with construction businesses. And then finally, it's just getting more difficult to get finance. So we think this all adds up to a big cash flow crunch looming towards the end of 2023. Finally, today we're going to close out with a bit of a late-breaking news in the insolvency space. Well, it's not so much late-breaking news anymore, but the government hit the ground running in 2023 with an unusual focus on insolvency reform. So first, in September last year, we saw the government announced a parliamentary joint committee into corporate insolvency. That committee is due to report at the end of May this year. So far, hearings are focused on reforms to improve the effectiveness and slow take-up of the small business restructuring process, the high cost generally of insolvency processes, and the low dividend rates which are generally achieved, and also the lack of access to information on restructuring systems in Australia. It's too early to know what changes the PJC Parliamentary Joint Committee is likely to recommend, but given the time and effort the government has invested in the process, it's almost certain that we'll see some sort of substantive reform proposals from its conclusion. And then also back in January, the Attorney General announced a roundtable to consider reforms to personal insolvency laws. And really, that's it for the content today. Now, we do have a process here for questions. I've got Aggie sitting on my right here.
Hello, everyone.
That, I think.
I think Michael and Jason's coming back.
Right, I might kick off, Aaron. We've got just a question about the SBR process around the eligibility. So just clarification that the ATO essentially wiped the debt once that process was complete, and the eligibility criteria for sole proprietors or partnerships.
Yes, okay, so the ATO will wipe that liability at the completion of that particular plan. It's still ongoing. It was a 12-month plan. Eligibility criteria, you pick me up, Michael, if I miss any. Debts must be under $1 million. That doesn't mean necessarily they have to be under $1 million when you first come and see us. There are ways, like for example, debt for equity swaps with related parties to bring down those total liabilities. But yeah, debt has to be under $1 million. Returns have to be substantially up to date. And there's one other one I'm missing. I can't think what it is.
So it doesn't.
Sorry, Aaron, the entitlements.
Employee entitlements. Thanks, Jason. Yes, so employee entitlements need to be paid. So that doesn't need to be paid prior to starting the process, but it does have to be paid prior to entering into a plan. So any superannuation guarantee liabilities will mean that a company cannot make a restructuring plan.
And just to close out, in terms of the specific question, it doesn't extend to sole proprietors or partnerships. It's purely for incorporated companies, proprietary limited or limited companies.
Yep. Is there one more question? I think Aggie's suggesting.
Yeah, there was a question. Does the DPN apply to startups? If yes, then will the ATO be more compassionate towards startups and waive the debt?
Yes, it does apply to startups. Again, it's companies, obviously. Will they be more compassionate? I don't think so. I think I'm told that's it. That's all the questions.
Yeah, I think that's all the questions from our side.
So, okay, well, hi everybody, it's Jason Bettles here from Worrells on the Gold Coast. Thank you very much to Aaron and to Michael for the presentation today. And thank you all to you out there in joining us for the presentation. with your CPD certificates, which will be emailed out in the coming days. There'll be a link to this session, which of course, as Michael indicated, was being recorded. So have a look out for that, and feel free to pass that on to your colleagues around the office who perhaps couldn't attend today's session. I'll look out for invitations for our future webinars. We're obviously doing these fairly regularly, and it's a fairly easy format for us to deliver and for you to listen. So look out for those. Other than that, thank you very, very much for joining us today. Have a great day. Thank you.
Thanks, everyone.